Sharon, Great Plains, and not sure about Megan.
And Shirley is on the Board of Elections and they are certifying the
Yes.
election today. So
That was the
she's
email I
working,
got.
she's doing that work.
Yeah, she sent an email and she
That
did.
was
Yeah.
the email I got later, then we got it
Yes.
later in the
Yeah.
day. It's been-
Yeah,
Yeah, she's on the Board of Elections.
yeah,
Oh my.
certifying today.
I'm sure that's a great experience.
Yeah.
Since we're in person, and we're, not in our little Brady Bunch box. Then we'll just go around the table and introduce everybody. If that would work, I'm Heather Clayball, the Associate Superintendent of Fiscal Services.
Christian Severe, Siegel Marco.
I'm Katie Siegel Marco.
Misty Turks, President of FCTA.
Dean Rose, member of the Board of Education.
Lynn McKay, Executive Assistant and Recording Secretary.
Renee Milburn, I am the Fiscal Compliance Officer for Financial Reporting.
I'm George Maxwell, a volunteer for the community.
Brian Rock, community volunteer. Jared Trooper Beat, assistant principal and vice president for CASA.
Alrighty, so. I don't have any announcements. So we'll have the approval of the February 23rd meeting minutes.
I move we approve the February 23rd, 24 meeting minutes.
A second.
All in favor? Aye. Excellent. We'll move on to the analysis of the investment performance.
You have your first quarter report, first quarter of 2024. Results for the first quarter were generally favorable, particularly led by the stock markets. U.S. equities up 10.5%. I'll just talk to some numbers on page 2, which is the market environment, and the blue bars on the bottom of that page represent the first quarter 2024 returns. So as I said, U.S. equities up 10.5%. All
It's this bond book here.
Looks like we're,
sorry about that.
that's okay.
That's right. I have it up on my computer.
International and emerging markets also positive. So kind of a lot of the talk during the last year plus really has been around inflation and when will inflation come down and when is the Fed going to start actually cutting rates. We haven't seen that yet. The inflation numbers have still been a little bit higher than expectations. So the Fed has held off on cutting rates. So we've been at since July of last year at 5.25% to 5.5% for short-term rates. And with that, the yield curve overall has continued to rise. So at the start of this year, 10-year treasuries were around 4%. At the end of March, they were 4.2%. And as of earlier this week, 4.4%. So we've seen treasuries continue to yields on treasuries continue to rise. With that, fixed income returns have been negative. So through the end of the first quarter, you can see your down 0.8%. Through last week, year to date, down about 1.4%. But we still believe that fixed income, given where the yields are, is a very attractive place to be. So we'll talk about that later in the presentation. You can see kind of through the next few pages, we have some more specifics on the different market index returns. And the yield curve chart and the chart on the Fed funds rate, those are both on page 7. The one area of the fixed income market that has been positive has been high yield. So you can see that on page 8 for the first quarter of U.S. corporate high yield bonds up about 1.5%. And both of our managers are what we consider 4+. So they do have exposures in those areas. And so our manager's performance versus the overall bond market has been favorable. Let me pause there. Any specific questions on the market or areas you want to talk about more performance? Then this one. And as I said, overall had a great quarter. So we have kind of an executive summary for you on page 12. Assets were up during this quarter about $11 million. So we ended at $188.5 million. The quarterly return for the Fed was 6.3% versus our policy benchmark of 5.9. So outperforming what we call a passively managed portfolio. And then, as I said, the kind of overall fixed income performance has been positive versus the benchmark. And so that was a big driver of the plans overall. performance.
I'll just highlight that 6.3, that's about an entire year's, assumption of return in one quarter, just to give you a sense of how strong the stock markets were.
Lastly, we have a bullet here about your asset allocation compliance, that you are within compliance of the policy as of the end of this quarter, but we do have some recommendations on some changes that we'll talk about later on. So that allocation compliance is on page 14. And this is the policy that's been in place kind of since we came on board in 2023. So 55% in US equity, 15% in international, and 30% in fixed income. And we've kept those percentages pretty close to the targets, as you can see there. And then the cash flow growth is on the next page 15. For the, as I said, first quarter up about 11 million. The fiscal year to date, we've seen growth of close to $22 million the first 9 months of the fiscal year, and that's a 13% rate of return. Longer term numbers very strong as well. So despite the cash flow being controlled, we've had significant growth in the markets. The more specific numbers regarding performance is on page 16. Longer term, your total fund has been strong. The 1 year through March 31st is 19%. We're coming up towards the end of the fiscal year, so we expect another strong double-digit return for this fiscal year ended June 30th. And then 3, 5, and 7, and 10 since inception have all outperformed your policy budget. The assets within U.S. equity are in an index fund with Fidelity, so up to 10% of the market as you would expect. American Funds is an active manager of the international equity portfolio, so looking to outperform there, which they have done on a 1 fiscal year to date basis and a 1 year basis, as well as all the way over to the right since inception column, which is just about 2 years. They're up 4.1 versus the index of 3.6. And then Dodge and Cox and Western Knight are two core plus fixed income managers. As I said, they've both added value over the benchmark, particularly in the 1 year period. So in the 1 year, your fixed income deposit overall, the blended return of the two managers is 3.6% versus the U.S. aggregate index at 1.7. Both have used their kind of high yield and other core plus areas of the bond market to add value versus the aggregate index. And then very small position in cash at the bottom, which you can see though, adding are up 5% on a 1 year basis. So cash has been a good place to be. The historical fiscal years are on page 19. The last fiscal year, we ended up 13.1%. That's where we were for the first 9 months of this fiscal year. And as I said, we expect another double-digit trend there, given the performance. So other than fiscal year 2022, you've had a very strong run of positive fiscal years historically. And then on page 20, we compare your plans to other public defined benefit plans, so OPEBs as well as pension plans. And you can see the unit return your numbers have been very high, 12, 9, 4, 11, et cetera. So they're ranking well ahead of many of your other similar types of plans. I'll point into fees as well. Talk about the overall investment expenses on page 25. You can see estimated annual fee is 0.2%. So 20 basis points on assets overall, very reasonable fees, and we try to keep that in mind when coming with recommended changes that investment managers do. Let me pause there and ask if there are any questions on the performance specifically. Assets as of earlier this week were, I believe, just over $190 million.
April was sort of a down one. April was out seeing the stock market, and then June is completely undone the negative from April. So it's been a roller coaster, and I think most of that finance point earlier is just about the Fed and really expectations for when they're going to cut rates. Everybody's continuing to watch this data come in, and while it's been certainly on the inflation side a bit more stubborn than the Fed hopes, if you look at growth, if you look at corporate earnings, things have been pretty good. I think better than most people expected. So, the timing of those rate cuts remains to be seen, but the stock market continues to look ahead, and it's able to do that more than the bond market. And I think that's why you continue to see the stock market do well.
You guys have a house view on money raise, what we got?
We tend not to fight the Fed, as the adage goes. I mean, they're telegraphing too, although they continue to be wrong in terms of their projections. I think what's important to keep in mind, and maybe where this cycle differs from past cycles, is that they could cut rates even if things are still okay, as long as that inflation number continues to trend down. So, we've sort of talked internally, 1 to 2 at this point still is possible. But if you continue to see inflation prints higher than expected, then it wouldn't be terribly surprising not to see any cuts this year. Really tough to forecast that timing.
Any other questions?
That's perfect segue into our next item, which is the fixed income structure review. So before we kind of delve into that, just kind of an overall comment for as I said, the asset allocation that we, are working with now is kind of the one that was in place before we came on board. But, you've all adopted a new investment policy. And so we're working towards kind of getting there incrementally. And so that's really kind of the point of this exercise. So you've already made a couple of decisions. Last quarter, you approved the private credit mandate. Those documents are in review, and as soon as we get those in, we'll get them to Hamilton Lane, and then they will eventually start calling your capital for the private credit investment. But that will be a gradual process. Once they start calling capital, it's about 12 months. And so it'll be kind of a slower build up to get us to that target that you adopted, which is 7.5% of assets. And then the other decision that we talked about last quarter was to not make an investment in the multi-asset class allocation at this point. Given the interest rate environment, we thought it made a lot more sense to invest directly into fixed income. And so that's the point of this review, is to talk about that 10% that is actually targeted for multi-asset class and actually investing that in fixed income. So that's what we kind of tried to lay out in terms of dollar terms on the first slide here. We don't have to start with this, but the overall goal is to take 10% of assets from equity from the 2 managers and move it to a new allocation within fixed income. So that's what we're going to talk about today. So it's about a $20 million move that we'd be taking from the 2 different equity portfolios and moving it to a new fixed income strategy. Your current fixed income portfolio as it exists today, you can see on page 3, it's about $55 million. About a quarter with WAMCO, which is Western Asset, and about 3/4 with Dodge and Cox. As I said, they're both Core Plus. Western tends to be a little bit more aggressive, and that's why we have a smaller allocation there. The current portfolio as it stands versus kind of what it looks like versus the aggregate index is on page 4. You can see some differences, particularly in the pie chart in terms of overall credit quality. So definitely a bit of a lower quality bias that comes with kind of the high yield exposure that the 2 managers have. So that's not concerning to us. It's just something that we wanted to, kind of wanted you to see. What that means is that it can lead to wider differences in performance versus the benchmark, or what we call tracking error. And that can be in a positive direction, but it can also be in a negative direction. So that's kind of one of the points that we tried to keep in mind with thinking about adding a new manager. You can see on the bottom kind of the difference in exposures, particularly in treasuries. That's the biggest difference. The index is about 45%. Our portfolio was about 11%. And then our portfolio has greater exposure in kind of the mortgage-backed areas as well as international fixed income, which the benchmark doesn't actually really have exposure to. And then in the middle of the page, you can see the duration, which is the sensitivity to interest rate changes, is basically in line with the benchmark for our portfolio, but we are yielding a bit higher, and that kind of speaks to our outperformance versus the benchmark that we talked about before.
If there are any questions about what the labels on the bottom mean, feel free to ask, but to Tanya's point, treasuries are the largest part of the benchmark, and then the other sectors that are corporates are basically asset-backed, which means they're tied to things like, could be student loans, in the case of MBS, or MBS, that's residential mortgage-backed securities that are implicitly guaranteed by the government. So it's a pretty wide smattering of investment grade US, at least US dollar securities, primarily US domicile securities as well.
So our recommendation, if you're gonna look at the smaller pie chart on page 5, is to add a third sleeve within fixed income and to actually add a passive core manager. So that would basically be essentially what we call an index fund. And the goal there is to try to reduce some of that tracking error or differences in the returns around the benchmark by bringing in a strategy that's basically benchmark-like. And the second, I would say, primary goal is to keep your fees low, which we talked about. So we'd be adding a manager at kind of a very attractive price point. So kind of what it would look like overall on page 6, you can see the core plus is kind of what our portfolio is today. So that will be 75% of the portfolio. The passive core sleeve would be about 25% of the fixed income. Really the primary difference in these two boxes, I would say, is the expected risk numbers. You can see we're bringing it down from about a 3 to 6 standard deviation event around the benchmark to about a 2 to 5. So bringing that potential tracking error or differences in returns down. Just another kind of graphical depiction of what that would look like on page 7. And then page 8 shows you that same characteristic page that we looked at earlier about comparing the current portfolio to what the proposed portfolio would be. You can see in the pie charts that credit qualities improves a bit, particularly in the AAA space. So AAA through single A goes from about 66% to about 72%. You can see the treasury number on the bottom increases from 11 to 19, and some of the mortgage-backed security areas, as well as the international exposure, comes down a bit from where we are today. The duration comes down very slightly, so a bit less sensitive to interest rate changes. We would bring down the overall expected yield on the portfolio a bit, but we would also be bringing down the risk associated with that. So that's kind of our recommendation in terms of actual implementation. You can see on page 9, we'd recommend implementing through the Fidelity US Bond Index Fund. This is a mutual fund similar to the Fidelity Equity strategy that we're in. We would purchase it for the same thing as the other investments. Their fee is the lowest out there at 0.025%, 2.5 basis points, which on a $20 million investment is $5,000. Keeping your overall fees very low. And then on the last 2 pages here, we just have performance of that strategy. As you would expect, longer term, the numbers basically match the benchmark to a T. In any given year, there could be some slight variances because they're not exactly replicating the index. They're purchasing a basket of similar like securities. So for example, in 2021 and 2020, you can see there were slight variances, but they actually negated each other over the 2-year period, 30 basis points ahead in 1 year and 30 basis points behind in the next year. And so over the long term, we would expect any slight differences in performance to basically wash out and you'd be basically getting that back later.
The point on page 11, the numbers in parentheses are a ranking in the universe of core bonds. And you can see certainly when there's some very strong return here, the index is going to lag active strategies, which typically do better because they're a bit more aggressively positioned. But if you look at years like 2022, 2018, where they were much tougher periods for the bond market, the rankings on the index are actually quite good. So negative 13% obviously is terrible, but that's telling you is that ranked in the top 20% or so of the universe because it had that treasury exposure. So I think thematically, we're aware of the aggressiveness of Western, and I think there's still on that for them in the portfolio. It's just that you can put a bit of a counterbalance in by putting a bit more in the index. I think going back to the theme here, it's really trying to take advantage of these higher interest rates. The timing, again, we don't know exactly what the Fed's going to do. You look at the numbers on bonds have done this year and they're negative, but think back to last year, despite the interest rate volatility in the last 2 months of the year, the bond market was up close to 6%. So it could be like that again this year, especially if the Fed does cut, meaning that the return could be lumpy. But the bottom line is when you have yields now in the bond index at a 4 to 5%, that's something we're trying to take advantage of.
That's a question on slide 8. So is your strategy typical to kind of match the index for duration and get your alpha just from is it, or will you go long duration if you think rates are going to go down?
Yeah, I mean, we try not to be too active in terms of matching, taking duration bets, the conversation earlier. I think there's other ways these two managers, and they've demonstrated this, especially Dodd and Cox on a consistent basis, not just in lower rated, because if you look at the top left, that pie chart, when Tiny was talking about the ratings, and you know this, Brian, but the ratings, if you think about what's considered investment grade and below investment grade, anything triple B and above is considered investment grade, double B and below. So the amount that's in double B and below is very small. So they're adding value in corporate bonds that might not necessarily be in the index, including a little bit in below investment grade, but they're also adding value in securitized sectors and things like commercial mortgage-backed securities to a more limited extent these days, but residential. And so, we do think that they can add that outperformance over time, and you could certainly do that with another active manager. I think this is in some ways a bit of a timing call on just getting that interest rate exposure and taking out some of the risk in the portfolio. And the fees to tie to it are always important.
And just, Western Assets has been on our watch list for almost 2 years now. It was like, do you see if you move forward with this recommendation that maybe much more about the counterbalance kind of deal? Do you see that maybe going away? Like, I've had members on the CASA side that understand a little bit of this stuff. They're like, it's been here for 2 years. What are you guys doing about it? Kind of deal. So I just want to kind of see what your take is.
Yeah, that's a good question. We, as a firm, like Western, historically they've had periods where they've underperformed. This track record on your performance page only goes back to 2019, but if you look back 10, 15 or so years, they've dramatically outperformed. So typically when they've had these periods, they've recovered quite nicely. One of the reasons why is they have a consistent approach where they'll be a bit overweight in the duration to sort of hedge against downside risk, but they'll also be overweight in things like corporate bonds and non-US bonds. So from a diversification standpoint, it can be helpful over time to have that. If you look at the performance, you look at the 3-year, they're still behind by about 2%. They have narrowed the gap. I think this is one where probably, by year end, we would recommend taking it off the watch list, assuming that things continue to trend in the right direction for them. You'll still get these months like April where yields move higher, and when yields move higher, bond prices move down. And when you have that overweight to duration, you're going to sell off. So part of the reason why we haven't made that recommendation yet is just because of the inconsistency of the performance has still been there. It's been there a bit longer than we thought it would, just like everybody thought that would be taking action by now. Maybe not everybody, but certainly us. But that's good to know that you're getting that, those sorts of questions, because that feedback.
Just when people look at it, they just see watch list and they're like, it's been here for a while. Like, what are we doing about it? Just with the way budget things are going, everything's going lately. It's just kind of making sure that we're looking good.
Yep. Do you have anything to add? I mean, if you look collectively at the fixed income portfolio, even if it's just these two pieces, that's a pretty good outperformance. Obviously, the absolute numbers are not great, and that's just because the bond market is what it is. But they're outperforming collectively over all these trailing time periods.
What are you proposing?
Timing.
As soon as administratively possible.
It would be it's an institutional index mutual fund investment. So there's little in the way of operational complexity. The trade can be made directly through the custodian. So this is a matter of days once we have the approval. And it's all consistent with what's in the policy statements. There's nothing from a governance standpoint that we're concerned about.
But like you were talking, the rates, who knows what's gonna happen with those? These are better if the, yields are not, it's on staying in equities for a little bit more this year.
Yeah, I mean, I think,
It's very nice to see. I mean, we're not talking big adjustments here, but
right. I think that's like,
are getting more passive than I don't know what's gonna happen in the bond market. Right.
It's hard to time. It really is, and that's the biggest challenge with something like this, and other clients will ask the same thing, when do we do it, or, we can move in gradually, but that's always another option. We have a cost average in over a period of 3 or 4 months, so that we're taking some of that time risk off the table.
yeah, I mean, part of this is, goes back to the asset allocation work we did with you at the outset and looking at the contribution of volatility from just stocks, because when you have 70% of the portfolio stocks, your biggest risk is a big drawdown, right? Because getting back from a lower point is hard. Like you need a 11.5% return to get back from 10%. So when we look at all the statistics around volatility and the impact that could have, basically what the report told us was you're very exposed to the equity market. Now that has been a great thing. Your timing's been excellent. You look at those rankings that Tanya showed you, top ranked plan over the long term in the entire universe is because the asset allocation has been so aggressive. So whether we do it, 10% next week, or whether we maybe do it in 3-4 tranches, completely up to you. I don't think we have an argument either way. But the bottom line is that the goal here was just to bring down some of that equity risk in the portfolio. And at the end of the day, if you have 5% plus yields in fixed income, even though right now it's taking a while for those returns to come through, we do think they're going to come through. And if your ultimate return objective for this plan is in the neighborhood of 6.5%, then 5.5% from 30% to 40% of your portfolio is not going to hurt the control. So totally understand the point. There's been very strong tailwinds in the equity markets. I mean, you look at the environment right now, everybody's getting even more bullish, which to us is something to just take a pause on and to think about that. But the long-term goal here is just to be disciplined to the investment policy. So that's what we're trying to do.
Well, one of the things that we had, while we did not have a budgeted, investment from our operating fund into OPEB for fiscal year 24, we were given the option, if we, at the end of the year, as we were looking at fund balance, that we could put up to $2 million. Based upon our current budgetary situation, we are not going to be able to make any transfer into OPEB for 24. Currently, in our 25 budget, we have $1.5 million that is coming back. That was our original budgeted amount we took out. That will be coming back to the 25 budget. And that is, as of right now, and we're still not quite balanced, but it is one of the things that we are strongly looking to protect in the budget, because we know that we need to, while we're in a good position right now where we're seeing increases, and without making an investment annually, A, we're not meeting the policy that the board signed in November of 21, and B, the market is what the market is, and it can change, and we could be in a situation without making the investment. So I just want to let you guys know that there's going to not be an investment in 24, but it looks like 25, and we'll be back to the 1.5 billion, and then hopefully adding the $500,000 to get to our stated goal by 2033.
There were a couple of years that the insurance fund was able to make a deposit into the OPEB of several $million, and our insurance fund is not going to be able to do that in the foreseeable future. So there's not money coming from there either.
Yeah, so above our reserve, our reserve policy, we were able
They have all this
to
stuff.
It's all
make
printed.
investments, and we are currently in a negative reserve, a small negative reserve position in our insurance fund. So that is not going So there will be no investment in that. Frankly, I don't know when and if we'll ever get back to that. So that, I just, that, in thinking about this decision, I just want to let you know that, because I don't know if that would alter any thought that you had around going towards, well, yes, I appreciate that the equities are growing and the idea of, making the perfect time, right? When to move out or when to move in. But I thought that might be a piece while we're making this consideration that you would know that there was not going to be an additional investment in FY24.
Yeah, I mean, if there's discomfort, a more gradual approach is not unreasonable. There'll be no extra cost to do that. I think, Heather, what you're saying to me is, what it means is more of a sort of a break in the process that was expected, but longer term, still going to be sort of be on track with the expectations. So I don't know that we would necessarily adjust the recommendation based on it. I think philosophically, you would ask yourself, if there's going to be fewer contributions, you get more aggressive, or you actually, maintain the risk level, slightly reduce the risk level. I at least didn't hear anything you said that would change, the recommended approach that we get here.
I'll just base my comment.
I think it's fair to see.
What I'm hearing about the capital markets, the next 6, we're in an election year. They kind of throw that out the window. Everything that the people are, the guys I respect are saying it's going to be a strong year.
Yeah, you just never know.
Well,
Where the rest of it comes from. 2022 is a great example of that. And then the rebound in 2023, nobody saw that, or very few saw that. So it's just, we've definitely had this, sort of all in or all out mentality the last 2 years. And to me,
But 22 with equities and bonds both down. When's that happening? That was not all year. I can put that off on the shelf.
I think that's part of the thing for us is that we don't see that happening again.
Yeah.
Because there's so much more cushion now baked into bonds in terms of the yield. Whether if you wanted to leg in over a few months or maybe do it over a few quarters.
Well, taking into account what you said, from what's coming in and the sources are getting tougher and tougher. Squeeze a little bit more out of what we had. That's all my thoughts are.
I'd just say from my experience on the committee, we've always played the long game. I mean, you have an asset that's underfunded, matching a long tail liability. And so we haven't tried to market time. And we've tried to be very steady. But
Would you, does that mean you prefer more of a dollar cost average approach here or?
I'm talking out loud, but if we do 20 and then you do 10 and 10, there's no extra cost. But at the end of the day, I mean, we're talking 20 years plus liability. Right? So, this is rounding error.
It's still the 15 years out.
Yeah, that's true. I just know it's still grossly under budget.
Yeah.
So I asked actually the question in an email the other day to Heather just about like where are we standing? Because it was talking the budget here the other
Right.
day or whatever, and she told me a check and various my neighbors were asking the same thing. Well, we are 25%.
25% as of our annual financial report for 23. So we will be doing that calculation this summer as we close out, so that we'll see where we are in regards to that.
You were 25%.
Yeah. We're 25% funded.
Yeah.
Well, and we're supposed to be, well, and 25% under our goal of 50% funded, for the liability.
Do you need a motion or?
Yeah, we were doing the anymore.
Because no insurance company would, for a number that will never exist, no insurance company would let us pay in one lump sum for everybody's insurance till they die. That's the number that's the target that the actuaries want us to get to. but that's not a real number. Like that is impossible for it to ever happen that way.
Well, I think the concern is, right, because right now it's $15 million on
Oh.
the training budget for our.
Oh, yeah. No, I'm not saying we don't try to get there. I'm just like, people look at that really big number and they're like, oh my God. And I'm like, we would never pay that in one lump sum ever, because even if we wanted to, even if we had the money, no insurance carrier would say, we'll take your premium today for somebody for the next 50 years. They just would never do that. But that's what the calculation is. How much money do you have to pay for your retiree benefits until they die? And it's never going to be a one lump sum. It's just isn't. I'm going to be retiring here soon, and I want our retiree healthcare solvent. Don't get me wrong. It's just you have to kind of put that perspective in when you look at the numbers.
And I think right now, because we are also, while we are not putting anything into the fund this year, we are also not drawing down from the
Correct.
funds. And we are not in, that is not even part of our consideration at this point.
Right.
So we know that
Six of us.
I was going to say for 6 of them.
6 of us.
well, yeah. So
You
that
need an
is,
OPEB primer for the board. You need an OPEB primer for the board.
yes. Consider that, unless we have our new. board.
Yeah, I was going to say, in December or January.
We'll have
we
that
could do one.
conversation.
And that orientation.
Exactly.
Yeah.
Watch their eyes glaze over.
Yeah. But I think that that's also something that if members are concerned that it is a pay-go item within our operating budget, and we do not see that changing for the foreseeable.
And that's what I usually tell them.
Right.
I've been on insurance forever.
Right.
For quite a while, so.
But I can understand that, because if you think about that
Yeah.
number, you look at $190 million, well, that could be exhausted in X amount of years, and that's not a very long time, and I'm 55 and retiring.
Yeah,
That's far less than the 20 or 30 years I'm hoping to live.
correct.
So how do I deal with that in regards to my insurance costs? So, but we do have a policy and we do have a goal. But back to this portion of it, I think, we do need a motion. And from my perspective, I think, I was not part of the original of this documentation, but I do know that it was reached very thoughtfully and with a long-term goal in mind. I do not have, from my perspective, an objection if the goal is 20 million and we want to do a 10 and 10 to give ourselves a little bit of time to maybe reach the equity rewards till the election or whatever, but it's at the census of the group. So I don't know if someone wants to offer a motion at this time.
I'll make a motion to transfer 20 million from. I'll make a motion to support the proposal and to do 10 million in the second quarter, 10 million in the third quarter with the discretion of our
Second.
Is there any discussion on the motion? All in favor? Motion carries. Excellent. All righty. So the last item, I think Lynn provided it for you, was the schedule of meetings. And we apologize if this is a Friday before Memorial Day weekend, if you're planning to get out of Dodge. Next year, we will not be at that time. But one question I did want to ask is, it looks like traditionally this May meeting has been an meeting. And we're happy to continue that, but I don't know for the convenience of the group, given work schedules,
Bless
is
you.
it easier to do all of our meetings virtual? And I just wanted to offer that out there, depending upon the group, how they feel about it.
From a standpoint from an administrator, I know many schools like it. Today I was lucky enough, I think, to lead, but I'm averaging 20 people out a day on Fridays. So just me being around is very, very helpful. They just top on the meeting and covering up.
Sure.
What I need to do.
Absolutely. Community members, you have any concern?
I would just say being in person is an opportunity to meet people that I don't feel like I can on Zoom. And so from my perspective, I like 3 Zooms and 1 in person,
Okay.
and I'm fine with that.
Okay.
And I don't know which one makes more sense, like the first one of the year or the last one.
I was looking at the first, it's August 23rd, and I think that would be
That's the first
terrible.
Yeah,
That's your
I
first-
wasn't
that's your first-
looking at
That's the
that.
first week of school. so-
Yeah, that's.
Yeah,
yeah,
I
and that's-
wasn't actually
that
looking
was
at the
what I was
date, I was
wondering
just
too.
thinking
I was like, it's
first or
not
last,
a
yeah. Or
July
in the middle.
Or one of the ones in the middle, maybe,
Right.
just something that, as we're coming into like a new.
November, I wouldn't want to
Calendar.
risk the 21st, that's a snow month, if we ever, get snow again in Maryland.
I hope not next year.
We don't have money for snow removal.
I don't have any salt money.
People, like, there was an audible gasp when you gave the daily amount that it costs to have salt and, No, they don't.
For 1 day.
for one day.
One day.
Because we have
And
71
we
more.
are-
70
and
plus
that is an improvement over
lots.
what it used to be. We used to just salt liberally, and now we are pretty conservative on our salt. But because we have 70 buildings, and the county is huge, geographically, so a little bit of snow is even worse than a big blizzard in some respects.
Well, and that icy mix that we get is the
Yes.
worst, because you can't shovel it, it's just salt's the only thing you can do. And those days are often delays, which means they really have to do it because people are coming in, the buses are coming in, the kids are coming in. When it's more of something and we're closed, they may or may not have to because it might warm up and everything melts. They don't have to worry about it.
That's exactly March now. Say, it's usually going on. It's crazy the things you think about.
I would say, just like a November one is easier to find attendance rate, which there's a lot more there and less meetings or whatever. So if we were to have one in person, which I'm fine with, I agree. If November one could be in person, that would be the one.
Okay.
Or so.
I don't know if there was a reason why the May one was always the in-person one, or if it just was, it's kind of the last one of the.
Last fiscal year, I think that's all it was, but I'd be open. I think November would be good.
It was May because the community members or whoever will be rolling on, so it'd be the last. So that
Yeah.
would be an opportunity.
Absolutely. Absolutely.
That's from my recollection.
Which I think that brings us to, so let's plan on the November to be the in-person meeting. That way we can continue that, at least being able to, and I agree, it is nice to see everybody in person. At least once, especially when you don't really get the, sometimes camera work, sometimes it doesn't. So that would be great. So let's plan on that November 15th meeting as being our perfect person meeting. And the last thing I have is, our community member, I think, will be closed session on the 12th is when that will be announced. So thank you very much for your time on the committee. We really appreciate it. We will have returning members. Derek, Shirley, who's not here, Renee will be returning to the committee. We appreciate that as well. And thank you guys for taking the time to serve your community. Whether it's your community at large or your bargaining unit members, we really appreciate it. And we appreciate the commitment and time and preparation that it takes to be here. So thank you.
I apologize for being so late. I'm sorry.
No, I know it's a school day and.
There's a field trip. I had to be there.
I was gonna say, you gotta feed the kids.
Yeah, we don't want to.
Yep.
Hungry bunch on a field trip, for goodness sake. So if there's nothing
Yep.
else.
Thank you all for making the trip in.
Thank you.
Appreciate it.
Very
Yeah.
nice.
We appreciate your expertise.
Yes, very much.